Welcome back to the channel. My name is Vandell, co-founder of Black Swan Capitalist. So in this video, you'll learn 17 essential lessons that can give you a significant edge within the crypto market, whether you're a short-term investor or a long-term holder. So you'll be equipped to avoid costly mistakes. You'll be able to identify opportunities and, most importantly, increase your chances of building tremendous life-changing wealth with this opportunity we have. So trust me, these insights could actually be the key to success or the reason you lose everything. So let's dive in. Firstly, timing the market is a fool's game in this crypto market. Trying to predict the exact highs and lows of the market every single time is a losing strategy. I'm telling you, even the most experienced investors, especially retail investors, get it wrong almost every time. Instead of actually chasing perfect timing, just focus on consistent strategies like dollar cost averaging or buying during market corrections or crashes, which is actually my favorite approach because you can go all in a lot at once and get more for your money. Number 2, do your own research. In today's age of social media, it's extremely easy to get caught up in the hype, especially from influencers who might not have real-world experience or wisdom in these markets. So don't rely on a 19-year-old from YouTube or Twitter to guide your investments just because they're yelling at the screen telling you to buy this or that. Instead, do the research on your own, look into the fundamentals of the project, the team, the use case, tokenomics, and adoption potential, and look at whether they're creating a solution to an existing problem, and if so, how big is the problem? And I'm telling you, quality research leads to good decisions and investments in these markets. Number 3, this is one of the most important ones. Buy in early. The key is to get in early. This is where the wealth is made. True wealth in crypto or in any asset class comes from getting in before the crowd. So get in early when prices are cheap. People think it's about the fundamentals only, what you buy. No, it's also about when you buy. So identify solid projects with long-term potential that are undervalued, and you'll have much greater upside. Don't wait for the mainstream media to validate your investments or some YouTuber. The biggest gains have already been made by then. Early entry is really what gives you the best chance of maximizing your returns and truly creating life-changing wealth. So buy more of the digital assets you're interested in, but when the prices are undervalued or cheaper. Number 4, have an exit strategy. If you're interested in making a ton of money and capitalizing on the 4-year bull run cycles, then you need to have a strategy. Having an exit strategy is what will save your gains because greed kills gains. An exit strategy is absolutely essential to avoid holding too long and watching your profits deteriorate, because this happens every time after the peak of the bull run. Historically, the 4th year of the market cycle is the bull run peak, and it's when prices reach their peak. So plan to cash out a percentage of your portfolio if you're interested in that during this time, and set clear profit targets and stick to them. By locking in profits at this stage of the cycle, at strategic points, you'll secure your gains and protect yourself from the inevitable market crash that follows, that we've seen historically every 4 years during every single bull run. And this will allow you to beat emotional decision making if you have a plan and stick to it. Liquidity matters. It's basically, in essence, the ability to buy or sell an asset, and it's extremely crucial. If your token or the coin you invested in has very low liquidity, you might not be able to sell when you need to, or you could actually end up selling at a much lower price than expected. But most times, more than not, you actually can't get out of your position and you can't sell. So this is extremely important and very overlooked. So always consider liquidity when investing in a project or a token. Even great projects are risky if you can't exit your position when the time comes. As a matter of fact, my cousin in Chicago purchased a cryptocurrency. He made over $1,500,000, but he was unable to sell the position. And then he later found out that they didn't have liquidity. It said insufficient liquidity, and he just couldn't sell. So, lesson learned. Do not blindly chase new coins and cryptocurrencies. I know new projects can be exciting, but they come with a lot of risk. And just because a new token or cryptocurrency is trending or being pushed by the mainstream media or has flashy marketing, that doesn't mean it's a good investment. Many new tokens and cryptocurrencies lack solid fundamentals and long-term viability, and this has been proven. Instead of chasing hype, focus on quality projects that are undervalued and cheap, with real utility, a strong team, a clear potential for adoption, because even if they drop 80-90%, at least you can sleep well at night knowing that you hold something with strong fundamentals, and you wouldn't be worried because you're thinking long term. So doing your homework and prioritizing quality over hype and nonsense will, trust me, it will help you avoid falling for quick fads, and it will significantly protect your investments from unnecessary risk. Number 7, do not overtrade. Holders always outperform traders 100% of the time, almost. Actually, the data shows that 97% of day traders constantly lose money. Frequent trading might seem like a way to maximize your gains. I get it, but trust me, it does the exact opposite. So my advice is stop pretending to be a trader unless you're a very skilled trader already, or you're 100% committed. Besides that, you shouldn't be trading. Plus, timing the market is nearly impossible. It's very difficult to do, and emotional decisions will actually lead to even worse trades. Additionally, trading incurs fees, and the more you trade, the more the fees eat up into your profits. And on top of that, you have a short-term capital gains tax, which is much higher than a long-term capital gains tax. So unless it's something you're interested in committing to and actually learning, it's a very steep and long learning curve, then it shouldn't be something you should be practicing. Master the market cycles. This is extremely important and can really give you an edge, because crypto markets operate in very predictable cycles, and it's been like that since 2009. It's every 4 years. So understanding the 4 stages of the cycle, which are the accumulation phase, the bull run, the distribution, and the bear market, is the key to really making smart decisions in the crypto market cycle. Why is that? It's because when you have a good sense of where we are today, where we are in the cycle, now you have a good sense of what comes next and what comes after we get out of the stage that we're currently in. So this is really the key to making smart decisions. The accumulation phase is basically the quiet phase, when there's no activity going on, everything is just consolidating, doing nothing. And this is when the smart money and the venture capitalists, whales, the smart investors actually start to buy in and accumulate before the prices start to take off. The second stage, when they do take off, this is the bull market. This is the bull run. It's when prices begin to soar, offering incredible returns. And after that, we have the distribution phase. And this is when the markets really start to slowly sell off. This is when the smart investors actually begin cashing out and exiting a percentage of their portfolio in the market. They start getting out. And after that, we have the bear market. So this is when prices start to decline, creating new opportunities to buy in, and we're back at square one. And the cycle repeats, and it's been like that since 2009. So learning the cycles and where we are in the cycle and how to identify them can actually help you stay way ahead and avoid costly mistakes by knowing when to buy, when you should be holding, and when you should be selling, if that's your intention. Number 9, volatility and market corrections and crashes are your friend. So when the market does correct in a bull market, you shouldn't be fearful or scared, because in a bull market, volatility creates opportunities. So instead of fearing sudden price drops and corrections, or even a crash that might be scary, you need to look at it as a discount because you're still buying the same asset that hasn't changed in its fundamentals, but you're getting a deal. And historically, market crashes in bull runs or corrections are actually followed by very strong recoveries. And the smart investors know this, and they use these dips to accumulate more at lower prices, basically setting yourself up for bigger profits and bigger gains right afterwards the market rebounds and the asset prices rebound again. And this is exactly what I warned the other day and I shared on Twitter, on X. The market was going through a liquidation that rippled out throughout the crypto market. And I put on Twitter, on X, that this is a discount, this is an opportunity to buy in. And the market immediately rebounded the next day. So that's just a perfect example. But this happens all the time in a bull market. And volatility is absolutely normal. You just need to view it differently. Like it's a Black Friday sale or a discount. And trust me, it will pay off. Number 11, when sentiment shifts in the market, this signals opportunity. Fear is a good thing in the markets. When the market is gripped with fear, it often signals a buying opportunity. I mean, what do you think the whales and venture capitalists and insiders are doing when the markets correct or when they crash? They're buying in because they know it rebounds immediately. The best investors understand that extreme fear always precedes significant price rebounds, and this is where the wealth is made. So instead of running away, you need to lean in when others are panicking and take advantage of the opportunity. As a famous saying goes by Warren Buffett, be greedy when others are fearful. So recognizing these shifts in sentiment can help you profit and get significant discounts right before the market rebounds. Number 12, do not FOMO. Have a plan. I'm telling you, the fear of missing out, and also known as FOMO, always leads to poor decisions and making you buy at inflated prices. So avoid that. Avoid this by having a clear investment plan and by buying when it cools down. So don't be chasing the green candles or when prices are swinging up. Wait for it to cool down and then buy in, or buy during a correction or a dip or a crash. And know what you're buying, know when you're buying, and under what conditions you're buying or selling. So sticking to a clear plan and buying during corrections and dips, this will really help you stay rational and prevent impulsive moves that will sabotage your success. Number 13, do not use leverage in a bull market, okay? It's the dumbest thing you could do, especially in a bull market, because leverage can amplify your gains, but it can also magnify your losses. You see, in a bull market, volatility can easily wipe out leveraged positions with a single price swing. So it's not even worth it because we're already going up. We're in a bull market. So what do you need that for? I'm telling you, many investors lose everything due to leverage, even in otherwise profitable conditions, like we saw the other day. In 48 hours, total liquidations exceeded $2.5 billion. So play it smart and play it safe. Avoid leverage and let the natural growth do the work in your favor. Number 14, diversify within the crypto market. Putting all your money into one cryptocurrency is extremely risky and not very clever because no matter how promising it seems, one thing is there's no guarantees in life, okay? So the crypto market offers a wide range of fundamentally strong projects with real-world utility, real use case, strong fundamentals, and high potential that are still extremely undervalued. So by diversifying across several solid digital assets, you reduce your risk and you increase your chances of capturing and taking advantage of humongous gains. So a balanced portfolio will help you weather downturns in one project while still positioning you for significant returns because you're invested in multiple great projects and you could reap the rewards from multiple projects, not just be in one token or one asset. Number 15, self-custody is the best security out there, okay? Keeping your crypto or your digital assets on exchanges exposes you to real risks like hacks, collapses, Ponzi schemes, or even frozen accounts. Self-custody, which is basically managing your assets with your hardware wallet in cold storage, is the best security out there. It gives you full control and better security. And remember, not your keys, not your tokens. So if you truly want to protect your investments and you're thinking long term, that extra layer of security of self-custody is the best way to go. And it's the safest thing you can do. So educate yourself on self-custody and how to do it properly and become more knowledgeable on it so that you don't make mistakes. And another thing is keep your private keys secure. Your private keys are your 12 to 24 keyword phrases, and that's basically the gateway to your crypto assets. And if you lose them, your funds are gone forever. So unlike traditional banking, there's no reset password. So you don't have that option in crypto. It can't be recovered. So always store your private keys securely, preferably offline in a hardware wallet or a secure backup. And do not save them on your computer or on devices. Keep them in a safe location and avoid storing your keys on, also cloud devices and things like that. Remember, you are the custodian of your own wealth, and keeping your keys safe basically means you're keeping your investments safe, and it's absolutely worth it. So remember that. Number 17, learn technical and fundamental analysis. This would truly give you an edge and make you a better investor. Now, you don't need to be an expert, but having a grasp of basic technical and fundamental analysis is an extremely powerful tool in your investing arsenal. And technical analysis for me is telling me when to get in and when to get out. And fundamental analysis tells you what to invest in and what not to invest in. So it really helps you understand price charts, trends, and market patterns and where we are in the cycle. So it really guides you on when to enter and exit a position. And on the other hand, fundamental analysis, it's primarily the focus on the underlying aspects of a project, from utility, the tokenomics, its team, adoption potential, the solutions to the problems they're creating, and it really helps you decide what to invest in. So combining these both actually allows you to make even better, more informed decisions and more strategic decisions than just relying on, one of the two. So it really is a powerful combination. Again, if you found these lessons valuable, make sure to like, subscribe, and share the video. And I hope to see you next time. But remember, success in crypto and in these markets come from being smart, having strategies, and sticking to a plan. So stay informed, stay prepared, and you'll be ready to take advantage of the great opportunities ahead. Thanks for watching, and I'll see you next time.